Good morning, ladies and gentlemen. Well, some very interesting developments this week. I'm pretty excited by what the market might do next week. First development is that we have closed in risk on in all time frames. So we are in SPY in all time frames, saying that we should be favoring buying dips in SPY. First time in since February, and to me that is pretty significant, and I am quite excited about what equities might do by the end of this year. I think we're going to go into a pretty powerful uptrend that is going to surprise many people. I think the odds of a potential melt up in equities are very good. The fact that we've managed to turn the weekly time frame into a positive one is to me very significant. Having said that, there is a however, and however, this is it. We are right up against the red zone in deviations in SPY. We might be there in SPY, but we are not there in individual sectors, as we shall see in a second. And that tells me that a big rotation is about to take place. And that is a rotation out of tech and into the laggard sectors. To me, this indicates not that we are going to collapse back down, but that we are going to go relatively nowhere next week in SPY. So if SPY goes up 0.5%, down 1%, up 1.5%, down 1%, just sideways and slowly starts following like here, that is to me very, very important. You will know that I was very excited by that 3,337 level in SPX last week. And the fact that we managed to close above it and lower in volatility below 2270, to me that is very significant. That tells me that we will basically trade around that level all week, but that the dips will be bought, and at the end of the week we should be slightly higher. We are opening up these deviations. If we look at the individual sectors, I think certain sectors are going to start playing catch up, like most probably XLE. But my favorite is going to be, the transports. They're interesting. I'm beginning to like the transports, but the ones that I'm particularly liking are actually XLB and XLK is the one that's going to do worst, I think, and XLF is the one I think is going to do the best. We will see later the relative performance that we can expect between XLF and XLK, but I would have thought from an outright basis XLF really next week at some stage has to trade this 2570 to 26 area. And that is quite a decent move. We've broken out of this consolidation, which has taken, approximately 40 days. And I would really expect XLF to prove itself next week. The bond markets are really not giving us that much of a clue. But I would have thought that now any kind of a dip down to this 37 level in 2s10s is a buy for a retest of this 50 to 53 area here. I think the odds favor a move up in 2s10s, and really also in the 5s30s we are, I'm looking for a move back down. It just seems unlikely to me that the bond market is not going to start feeling a bit sick with all this new issuance and the fact that equities are beginning to outperform. It would be worthwhile just having a quick look at what European fixed income is doing. This is the bobble, and as you can see now, it's held beautifully this area around 75 basis points. I would think that risk reward for next week is definitely that we trade up towards this minus 61 area. Minus 61, minus 62, that is the risk reward. And in the bunds, I think the risk reward is that we go up towards minus 40 basis points. That to me is the way I will be playing it. I will be playing it for higher yields. We've been in this box for such a long time. I think it's about time we went and tested the upside, especially since I think equities next week will outperform. I mentioned the 530s as well. If you remember, I covered down here and I said that it was going to take a long time to achieve this level, 154 basis points, probably all year. I am now prepared to start giving it a go on the short side again, looking for a widening. I think I will probably do it first thing on Monday, but if you see it trading 105 basis points and this line rings for me, I think an acceleration is probably just round the corner. I think revisiting over the course of the next 2 or 3 weeks this 120 level is more likely than not. I think the 530s are telling you the story. The yield curve should now begin to steepen slowly. We are not looking for huge things, but mind you, 20 basis points in a market which basically is stuck is huge. And I'm certainly looking for the trend in the yield curve to be one of steepening in both Europe and in the US. I think the weekly chart of TLT shows you quite well what levels you could expect. I think you've had a bit of a reversal last week. We tried to go higher. I think the risk reward is now for lower. I think the level that you're looking for is around 165.5. Don't forget, this is going to be very slow. This is not going to be impulsive. And finally, I'll be looking for this kind of 162 level. So 165.5 first, finally 162 over the course of the next month, let's say. I am absolutely convinced the Fed is going to be able to hold the yield curve. I am not worried about a complete collapse here in TLT or in anything to do with bonds, but I think steeper, as far as the curve goes, is more likely than not. We're always playing risk reward, and that to me is the risk reward, and it's as simple as that. Steepeners everywhere. The spread between the US and Germany remains absolutely stuck. It's not doing anything. I like this sort of bull flag kind of thing, and I think it's more likely to go towards this 120 region than break through the 100 and 101 basis points region that is so important. If it breaks through 100, I think I am wrong about the steepener. Okay, it's as simple as that, because I think 2s and 5s in the States are absolutely stuck. They're going to go 2-3 basis points either side of where they are. And if we start breaking 101, that can only mean that the US 10-year is actually flattening big time, and therefore steepeners are going to be out of the question, and that I'm basically wrong. But to me, it's more likely risk reward says that we go up towards at least 115 to 118 basis points over the course of the next couple of weeks, and that actually makes Dixie go up. And we will have a look at what I think about the dollar in a second. I was lucky enough to cover my position right at the lows, I think it's more likely than not, having rejected the 92.56 line, that we now bust through the 93.63 and basically go back up towards the 95.07. I'm a seller at 95.07. That will be roughly the 50% retracement, but the 0.382 retracement is here at 94.54. So basically you start building short positions between 94.54 and 95.16. This is a retracement. Nothing goes down in a straight line. I still think that eventually the dollar breaks lower. As I told you, that's the thing that makes most sense to me. But while the curve is steepening for a couple of weeks, favoring XLF, favoring rotation out of things like XLK, I think it's more likely that the dollar stays bid and retraces some of these moves. I mean, after all, we're still right at the bottom of the Bollinger Bands on the weeklies, and really we're quite a long way away from the 200-day moving average on the dailies and all the other moving averages on the dailies. And also, what's more important is the market is very, very badly positioned. You can see from the RSI how oversold we are, how we made a divergence here, a lower low but a higher low in the RSIs, how the stochastics did the same divergence, and how the MACD is hugely oversold and ready for a bounce. I really would not be surprised by a move back up to 95.07. I would love to see it to start getting short again. To me, that is the better risk reward. Nobody says that you have to be long the dollar. Just, if you've covered or whatever, you just wait for these kind of levels anywhere between 94.54 and 95.16 to basically put your position back on. And that makes far more sense to me, because if the curve is steepening, the dollar should have an underlying bid. If you look in terms of Euro USD, this is a monthly chart. You'll see that we are above the Bollinger Bands still. So really doing something like we did here back in 2017, just basically trading between 118.40 and 115.73 is, to me, the more likely scenario. I would love to see 115.73. I think that matches with that 95 and teens in the Dixie. If we look, that is on the weeklies, we still closed right on top of the Bollinger Band. If next week we traded between 118.40 and down towards this 116 and a half level, why would that surprise? I think a little bit of a retracement, the pause that refreshes, is probably more likely to do some good in Euro USD. If we look at the dailies, you can see how, these Bollinger Bands are going to turn in. I think coming down towards 116 and these moving averages is going to be absolutely healthy, and, something that is more likely than not. And after all, we're here to play the odds, aren't we? Have a look at this divergence, higher high here, and the stochastics have made a lower high. Let them come back down and get oversold, and then we can play for a bounce higher. But to me, everything indicates that we will, over the course of the next week or so, trade down towards this 116 to the 115.50, 75 area, which coincides with the 95 and teens in the Dixie. I think this is going to be a wonderful level to play for another bounce and another wave. If I am looking for a steeper curve and a bit of a higher dollar, the thing that might have shot its bolt is the precious metals. And in gold, really, I would not be surprised to see a move below 2,000 and something like a 50% retracement of this last move up around the 1900 or level or just below. We are above the monthly Bollinger Band. People have been buying gold like crazy. A bit of a reversal is the pause that refreshes. To me, the very, very important level over the course of the next couple of months that we are unlikely to remain below is 1763. That is where my next bids are. And I'm not looking for that much of a move in bonds and the dollar, and therefore, a move certainly down towards 1900 is your first bounce point. And it's healthy because you can see how far away we are from all the moving averages. A move down towards the 1900 level is something that I'd love to see, but 1763 is the absolute bottom of the move that I can see in gold. And here is the reason why you shouldn't really expect much of a move lower in gold. TLT over GLD, I think the break of this line is very important. I think we will bounce back towards it, but the path of least resistance from now on is down towards this 80 level, this level that has been support for in this area back down in 2010. Since I don't expect TLT to move that much, I can't really be looking for that much downside in gold if I think that that is the path of least resistance, and then gold outperforms TLT. Also, the reason why you can't be looking in the immediate future for much of a move in SPY TLT is because we have this 200-day moving average coming down and this 0.618 retracement of this whole move back, from in 2020. That to me says that SPY is going to be very contained on the upside. We looked at deviations earlier which showed you that it's in the red. So that therefore you should not expect an outright move of very much in SPY next week. I think SPY is going to be very contained next week, but the rotations within SPY could be significant. Volatility also last week did something important, closing below this 2270-ish area, which I think was very, very important. I think now for next week we will trade between 20 and 22, 20 and 23. It's just another nail in the coffin of the equities are going to break down theory. We have a long time before volatility returns back down towards the low teens. The 200-day moving average is still pointing up. It's going to take a lot of time to keel over, and for the 50s and the 200s to cross. Therefore, I think the market next week of SPX is going to remain contained, but the upside is to be favored because of continued rotation into the sectors that have been underperforming. The lower level of volatility, but the fact that we've managed to break on a closing basis 33.37 indicates to me that we will have some upside next week, but we will be returning to that 33.37 line and bouncing off it. I think the range next week is not going to be large. In fact, it's likely to be one of the smallest we've seen for the past several weeks. And that is also because we are on the dailies right up against the Bollinger Band. We keep on trading very, very contained between the moving averages on the downside and the top of the Bollinger Band. We are unlikely to break that Bollinger Band by very much. So really the upside is no more all week, it's no more than 50 points, but the downside is also very, 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 very well contained. But here is what could move next week, and I think will move next week. We had the first inkling of it on Friday when the tech sector and NQ we're trading much weaker against SPY and Russell. And when SPX, as I thought was very impressive, kept on bouncing off 33.30, which equates to 33.37. However, FAR NQ went down. That to me suggests that we could return to trade in this kind of a box between the QQQ and the SPYs, i.e. around 79, between 79 and 76, this kind of a box, and back down to this kind of level, this 162 against the Russell. That would be nothing but healthy, I think, and that indicates that the laggards are going to break out against the leaders, and we're going to have a period of outperformance by them. And here we can actually see how far XLF has been left in the dust by XLK and even XLV and even XLI. I think a move back up to these kind of levels against 25 to 26 over the course of the next couple of weeks in XLK, XLF is not out of the question, but that is a very large move. Almost 10%. Does that mean that QQQ goes down 2 or 3% and XLF rallies the biggest part of the balance? Absolutely. I'm not looking for a disaster in NQ. I'm just looking for vast outperformance from these sectors which have been huge laggards against XLK. Nothing really that should surprise very much. I think, given the fact the volatility has broken down in SPY, given the fact how far SPY XLK or SPY QQQ has moved, it is now normal to expect a period of basically return towards the moving averages in those sectors relative to XLK. So I think for next week that we will see basically a neutral week at best in the Qs and in NQ, and really a much better performance by the laggards. For those of you who like trading Europe, I think the bearishness in Europe is probably overdone, and if I'm looking for a period of a slightly stronger dollar, it is quite likely that the DAX will try and trade at least 12,885, 12,900, probably even get to 13,000 again. I still think this gap is going to be filled, this gap up to 13,515-ish. I think the DAX next week is going to do just fine. I think the bearishness of the past 2-3 weeks has been overdone, and a bounce there is more likely than not. But you can see that from what I'm looking from SPY, I think the outperformance of DAX, if there is any, is going to be very limited. I'm not looking for huge moves in the dollar. I'm not looking for huge moves in the relative level of the fixed income between one country and the other, and therefore the level outperformance, I think it's unlikely to be anything more than 1% or so. So nothing much to write home about, but I would certainly expect this 12,900-ish level to be tested next week in the DAX. And at the end, a quick recap of what I've been saying to you and showing you how the pieces fit together. USD, if we see 95 and teens and the Dixes, or just around 116, let's say, Euro USD, that's going to be a great level to pick up euros and short the dollar. Gold, unlikely to have much upside if I'm looking for steepeners in fixed income and a higher level of the dollar. Therefore, I would leave precious metals alone and just look for levels to pick them up if there is a puke out. I think in
steepness will be favored in fixed income. I'll be very surprised if the curve doesn't steepen, especially in the 530s towards 105, 110 basis points. That's what I expect for, that's my favorite trade in fixed income. SPX, I think, outperforms the Qs and NQ. The critical level is still 33, 37. I think there's going to be battle royal there. I think that, as XLF takes the strain and goes up into the high 25s, it's going to be enough to keep the market around 33, 37. We've got some interesting, an interesting position with the put spread at 33, 37. So all we can do every time it bounces down there, we buy XLF and basically hedge it that way. So it's going to be very, very interesting next week. I think this rotation could really start going. Thank you very much indeed, and tweet you on Monday.